The tariffs are happening, and how is that going to affect the multifamily market as tariffs across the board are being implemented right now? And for while we're recording this, they are still in place as a negotiating, as a real policy. And again, how is it going to affect inflation, interest rates, GDP, a potential recession? Because we're also watching the 10-year Treasury declining in yield. It's about 4.16% today. Is that going to give some much needed relief to multifamily owners that are struggling with high interest rates, some slow rent growth? And they're looking at a wall of maturities later on this year. We're going to find about all of that and more on this episode of The Gray Report. Let's do it. Welcome back to The Gray Report. I'm your host, Spencer Gray, CEO of Gray Capital, joined again by Dr. Matt Bosnagel, Director of Communications and Marketing here at Gray Capital. Matt, we're talking about tariffs. We're talking about multifamily. We're talking about inflation. We're talking about an uncertain world.
Yeah,
you've been digging into this tariff business
as much as I can.
I mean, the whole market thought that this wasn't actually going to happen.
Yeah,
and thinking that these are just negotiating tactics. Mm-hmm. And we said previously on this podcast that look, some of that is going to be true. It's negotiating tactics, but because the market believes that now, it's because Trump is some of a conscious actor. He knows that he has to make his threats real in order to actually get the concessions that they are pursuing. So I don't think it means that everything's going to last forever. But he at least has to convince the entire world that, hey, we're serious when we talk about these tariffs, and the market is reacting today. I mean, major sell-offs across the major indices, and Treasury rates, specifically the 10-year Treasury, has been coming down over the last several weeks. We talked about it last week, even more today, in kind of the low 4% range. Yep. This week also, we had a print from the Atlanta Fed on their GDP now showing possibly negative GDP growth for the month of February. Then
they're going to change how they're calculating it. So.
Probably, but we went from being in an environment where we're saying no more rate cuts, we're going to see more inflation, to all of a sudden maybe we have negative GDP growth, and maybe somehow tariffs, maybe they could be inflationary, maybe they could be deflationary if they reduce growth overall, and could it even push us into a little bit of a recession that some say we've needed for a while. Matt, you've been digging into this. What's your take?
Well, just to reference what you were saying before about whether it's a negotiating tactic or not, there is some analysis that we'll cover today that covers like how much is this a kind of bargaining chip, or how much is this like a deep-seated it is its own end kind of thing. And I think there are some tariffs that you can't count out for that. I also think at the same time, he's very responsive to changes in the market or even opinions. However, if you think back up to 4 years, we did not see severe tariffs, and there was also a more vociferous opposition to the idea of tariffs from Republicans. Now I think that Trump is more in control of the party. He's not going to see that opposition, but he may hear from it in terms of like the Dow Jones numbers and the S&P numbers and all that kind of stuff.
I wonder if they've got like the real econ and math, and then they've got the Trump econ and math, because they're not necessarily the same. I mean, just like from the core concept of like who pays the tariffs, there hasn't been like an acknowledgement of how that actually works. That it's like the importers, the American companies that are importing goods are paying the tariff, not the countries that are manufacturing it. It encourages then onshore manufacturing and purchasing of American goods, but there's that disconnect in just like the reality and the definition. And it seems as though also that there's someone is mentioning the nuance, whether it gets fully taken into
it is interesting in a lot of the defenses of the tariffs. I don't hear that much on like we're going to build factories here, so that's going to make it cheaper. They gloss over that a little bit. They emphasize on like no, the people that are importing it, or I'm sorry, the people that are exporting it to us, they're going to lower their own prices. Like that's not going to happen. If anything, what happens is you kind of encourage us to build factories here, but guess what? You can't do that in even like a year. That takes like many years, and
Yeah.
so
Now,
there's no way.
some of it started during COVID,
Yeah.
and even before, with the original Trump tariffs. There were some companies that made decisions then that are coming to fruition now.
Yeah.
But you're right. It's you make that decision, that strategic decision of we're going to reallocate manufacturing from one country to the other. Yeah, that's a multi-year process. But even yesterday, there was a major announcement from Honda that they were going to be moving manufacturing of the Honda Civic, or a large part of the manufacturing, from Mexico to Indiana, which was exciting. From being a Hoosier, it was great to hear. But what offsets that is Indiana is also a big manufacturing state, big steel producer. So effective steel prices. If the price of steel goes down, that certainly affects jobs in Indiana, in general, manufacturing in general. But then also farming and agriculture, which is like Indiana's largest export, soybeans in particular. China has already reacted to a tariff on soybeans, which they also did back in the first Trump administration. So it's this patchwork of different policies from different countries related to different industries that affect different regions. But then there's again the downside of like tariffs on soybeans. But then there's the upside of like, well, maybe we get a new factory here or there. And, are we talking about the couple of jobs? And again, like my family, owns farms. I've, worked on farms. So, they're definitely empathetic to farmers, but, we're talking about dozens of, handful of jobs here versus thousands of jobs manufacturing over there, in their large markets.
I think that the effects are going to be really complicated. There are so many materials that move back and forth that it just seems like so incredibly inefficient. You're paying for all that, and another thing is like, and this is in some of the sources discuss this, all these relationships, all these contracts, all these deals that were made previously, how you're going to source this thing, how you're going to, the supply chains involved. When you're flip-flopping like this, or just the idea of it being flip-flopped, like, that's not a good idea. So now they have to change, and then they got to change back, and that's delays, that's time, and that's money.
The uncertainty.
Yeah. So that uncertainty itself, it's already happened. That has already happened, where people have paid more because they don't know what's going to happen. There was a recent January, like if this was like a producers materials, like construction materials, they collected it. You referenced this earlier, and I was like, I can't find it, and then I did find it. But the rebar was expensive because people were maybe they're looking forward is what they're doing. And so trying to pay up this premium means, well, because you think it's at risk, and so here it is. There's the risk premium by not knowing whether there's going to be a tariff or not, and because people don't know there's a tariff, then they'll kind of almost assume it's going to be a little more expensive, because on the whole they'll want to hedge their bets. So just like toilet paper hoarders, people are willing to pay up, and they're going after things that are going to be threatened. That's already higher prices. So
yeah, I mean, if you're a supplier, you're importing, you're going to start adjusting your prices today. And that, I guess that's where I come down to, of like, how do I assess this, is that related to housing, related to multifamily, is that it's not going to be cheaper to build apartments going forward than it was previously.
And
the tariffs aren't going to make anything cheaper. And there's a high probability that it's going to increase the cost of construction. Not again at the immigration piece, but a lower supply of labor also increases the cost of production. So we're having building costs increase, where many developments right now just don't pencil because the high cost of financing and equity isn't available, and interest rates are so high. So where we've already seen starts decline dramatically, I'd have to expect that we'll see further declines of starts. So we're looking now.
Permitting's down.
Permitting is down. So when we look into the future, we're looking at less apartments being delivered, which is unfortunate because we need to build more housing. But from a pure investment standpoint, when we look at acquiring properties today, if we have a hold period that's 5 to 10 years long, it starts to become interesting because there's not going to be any new supply coming in the market, and there's still going to be demand for housing that doesn't go away. It's inelastic, and incomes still today, income growth is strong. Like income growth is like surprisingly strong.
This is where the real risk of like whole economy, if the whole economy gets turned down, that may not be the case, but currently
true.
yes.
You 100%. But there's not necessarily wages usually go down during a recession, but if we have a little bit of more of a technical recession, a real recession this time, but like still technical, because we have a confluence of government spending being reduced. A lot of GDP growth has been from government spending the last several years. So we have a reduction in government spending, but also just a general slowdown related to tariffs. But we could be in an environment, but there's still demand for services. I mean, we still need to hire workers. We could see 2 quarters of negative GDP growth, qualifying as a recession without the economy absolutely crashing. I mean, again, there's always a scenario that's worse, but I also see a scenario where we go through a period of just growth slows down because we're reordering the economy in the United States, but also like the global trade order. Like that's being potentially reshuffled right now. I mean, I was listening to Bloomberg earlier today, and that's what's being discussed. It's not just tariff here and tariff here. It's we have to rethink trade in general. Now maybe it all gets reversed next week, and we go back to what we've been doing. But assuming that this will go on at least for like the medium term, or some of these are going to hang on, or even if just this threat hangs out there, and so people decide, I just don't want to live through that again. I want to insulate myself from future downside. That just reordering and reshifting, just like in COVID, everyone was a reshuffling of the economy was turned off. And that reshuffle immediately caused a recession just because we didn't do anything for a couple months. Obviously it's a different extreme, but when you reshuffle everything,
that costs money.
It costs money. There's inherent inefficiencies going from one system to the other.
Like the guy that was taking all of the copper from China, or the steel from China or whatever. That guy. Well, we're not doing that anymore. So you lost a job. Like that. That's going to happen. Easy. It's just. You're right. We did see it, and just the transition itself cost a lot of people because there were ways of life that no longer were the same.
There's niche industries, niche position, that aren't going to be relevant anymore. Now, new opportunities, like if we're building more things here or elsewhere, there's going to be new jobs that are created. But just like we're talking about, AI and the transition to more AI in the economy and more AI jobs, is it just the jobs don't necessarily go away, they just transition, but then there's this transition time of what happens in between. That could be.
And again, we are early into this, 1 month into the presidency, 1 day as of this recording into the tariffs, which like you said, kind of to remain a negotiating tactic, the tariffs have to be felt as real. So we're not allowed to know for sure whether they're going to be forever or whether they're going to be temporary, because you can't give away the game. I will run down them, and we have them on the screen here.
What's real?
So in effect right now, as of now, in effect February 4th was a 10% tariff on all imports from China, and now in effect is a 25% tariff on all imports from Mexico, a 25% tariff on most imports from Canada, which with a lower rate for energy, and an additional 10% on all imports from China, and then planned. We gotta so get excited. If you love tariffs, get excited because we have a whole schedule for you. Planned for March 12th is a 25% tariff on aluminum and steel, and on April 2nd, a unspecified tariff on all agricultural products, and this is in the category of world, by the way, and also an unspecified tariff on all foreign cars. And then in the grayer proposed area, we've got an investigation into copper imports and lumber imports. So a lot across the boards, a lot of different ways to slice it. I think that, again, I hate to say it, to describe how many industries this will affect, not just like home builders, which we'll get into specifically, but how, at every stage you're sending something across and back, and how they're going to implement this even is kind of mind-boggling. I don't know how that even gets done. Is it good? It may create some jobs of people that have to be the ones that assess this.
Said the External Revenue Service they're going to create, which I think.
Oh,
is
okay, there you go.
But like they're going to fire half the IRS agents and make them XRS
Wow.
Agents. Because I mean the concept is that there was a period in the nation's history where we didn't have an income tax really for a big chunk of our nation's history, and we relied on revenue from tariffs. But the federal government was like a fraction of what
sheep on the lawn era of American government. Sheep on the White House lawn era.
Yeah, exactly. Before we had like a real standing army. So things have changed, and the whole world economic system also has largely changed.
Yeah.
We're not on a gold standard anymore. We're on fiat, reserve currency,
Yeah.
the U.S. petrodollar. So it's like things have changed a little bit.
And that's what I can't keep getting past is like you work with what you got, basically. Like, it is a little bit of a wish fulfillment to think that people will just eat this cost for tariffs. Like, these are pretty dramatic. And
I was reading some research that it's not as though there is a lot of data that shows that importers do not pass 100% of the cost on to consumers. That there can be a range of where they will eat it up to an extent to continue.
Yeah, I think I talked about that. Maybe it was when Jay Reeder was in here. They used a case study of something like it was like washing machine tariffs. So it was during Obama era, and they ate the importers or however you talk, the people bringing the stuff into the country did eat a little bit of it.
Yeah, but it's just tough because I'm just such a free market guy, and I just don't think there should be I think we should just be able to trade with like individuals anywhere, like just countries get out of the way, government get out of the way, let us buy stuff, let us sell stuff. We're going to have like the most efficient markets, we're going to have cheaper goods, and there's going to be jobs for everybody. But the reality is like we do live in a world with trade restrictions and tariffs, and other countries have tariffs on the United States, and this idea of like, well, we're not going to accept the current tariff regime, the paradigm that the world is using. We have the most leverage. We've got we've got most of the nuclear weapons. Well, we've got enough nuclear weapons. We've got all the aircraft carriers. Yeah. We have the world's reserve currency, and we just want to throw our weight around to maximize our position. And see what we can get, because we're just not happy, and everyone has just been too nice over the last couple of decades. Just saving face and happy diplomacy, and see you at the next state dinner. And Trump doesn't care about he's like got to break a couple eggs and want to make an omelet. I think I understand the strategy. It's just like it kind of goes against my core beliefs in regards to economics and how we should think about the economy and dealing with other countries. Yeah. But if I take myself out of my like core, the first principles and what I actually believe, it's like, okay, I think there is a strategy.
Yeah, no, I think that there is a strategy what Trump's doing, but I also think that it wasn't like a 100% like cost to us to be able to have our aircraft carriers going around the world, to be this country with a large S, to give so generously and to maybe suffer these tariffs or whatever. We still do have the indisputable position right here. It just raises a lot of unknowns, and that's why I don't know if I'd like to do it or even test it.
Well, and it comes back to, and then we're getting into more like geopolitics. And then we can get back to real estate.
Yeah, we'll go to the housing market or CRE market.
But it's do we the United States has wanted to be like the better person, like the adult in the room, and like we don't have to maximize our position at every corner, even though the broader strategy did, because we ended up just being in control of everything. But we'll play nice to be in control.
To be in control. That's what I kind of thought about it for sure.
But now we're like, no, we're not gonna do the playing nice thing anymore.
Yeah.
And so how the rest of that goes?
Do we lose control?
Do we? And then there's do we do we want to control
Yeah.
everything?
Yeah.
And it comes to these deeper questions of, again, from whether being the policeman of the world to like running, world diplomacy. But then if not us, then who? Is it
Yeah.
Russia,
Yeah.
China? Or do we live in a, multipolar world,
Yeah.
bipolar, or just, it's just one superpower? We're going to be the big empire and we're going to do it all.
Yeah.
Because we believe we have some moral authority, which I don't know where we get it. But besides being the best country, we've got a great constitution and good people. But man, anyway, let's talk about
it's
real estate,
complicated.
man.
Well, what did Warren Buffett say? Something about like it's like war tariffs are something like that. So it's relevant.
It is economic warfare. I mean,
yeah.
It is true.
So tariffs and CRE. This is a BizNow article talking about the inherent implications, or maybe now the active implications of these tariffs. We didn't see a letter from the NAHB before the tariffs came into effect this time, but previously we did. So who knows if they could have that effect?
You put a lot of weight on that letter.
I know. I don't know if they were on the negotiating table, but that's how it happened. The BizNow article cites increasing construction materials prices, and it's interesting to see. Like I mentioned before, there was an uptick in near-term monthly pricing, but even though like the yearly pricing was kind of even, but that's just something that they cited, and those were January numbers, so they were largely like anticipating future tariffs. So that's the whole thing. We're going to get the data in a month from now, and we won't know exactly how everything shakes out here.
I would wager money that not all. Some of the tariffs will still be in place, but not all of them. Not all of them will be. Mm-hmm. There'll be some capitulation. I mean, the scrambling is extreme.
Yeah, and the article and here's another quote, and they say that prices for products like rebar, glass, steel, and aluminum for upcoming projects are now expiring after only days. Typically, quotes for such contracts remain in place for months at a time. So things like delays and timing and this uncertainty about where the supply chains are going to be, that's already happening. That's really interesting, just about the kind of snarl of traffic that this is being caused, and as everyone renegotiates, and I think that's again like to the detriment of builders specifically. There's so many of these things.
Yeah, I think for developers this is going to be really tough. Now, if you've already got a project that you're delivering, I think you might be in a much better spot, or you've already purchased your materials. All right, actually, you could be in a really good spot because you're going to be delivering when no one else is delivering. Yeah. That's what I talk to a lot of developers that they say. It's like, if we can get in the ground now, we're going to be delivering into a very favorable environment. Yeah. But if you're putting your development together today and you don't have your materials, you're looking at a completely different cost structure. And so, if your costs are up 15 to 25%. Are your rents going to be up 10, 15, 25%? Mm-hmm. And I'm not saying that the rents will be there, but in order to make the development work, they might have to be. And at some point, that increased cost does trickle into higher rents. If wages can keep up with it. Yeah. And so that is giving us a little bit of a leading indicator of just what the cost of housing is going to be. Mm-hmm. Out in the future. Yeah, no, that I did hint at it. This construction prices, they did see a little bit of a monthly uptick, that was slightly more powerful maybe than like the yearly uptick in many of these cases. But my question is how is this going to, like you mentioned before, is like what effect is this going to have on the lending market? Because also. Lending market? I don't think that the Fed funds rate or the 10-year Treasury is going to change like that rapidly or quickly enough to bail people out. And so, Like I think like when we've talked about it, a lot of it's on the margins. If every 10 basis points the 10-year moves down, or Fed funds rate, SOFR. There's a borrower that all of a sudden their deal will pencil, and it means, more proceeds and less cash in, or even, a neutral refinance, or all of a sudden you can get to a sales price that makes sense because, the relation between cap rates and interest rates, have improved. We have to make some serious progress before, if the 10-year Treasury was in the mid threes and the Fed funds rate was even lower, I mean, that would help out. It's a much more favorable situation versus the 10-year at 5%. Yeah. I mean, the 5% to many, not all, that's like the last nail in the coffin for some of these deals, syndicators on bridge loans. that have loan maturities coming up. But if 10-year is 4 or sub 4 in the threes, that opens up a lot more possibilities on the refinance side or on the sales side.
Yeah.
So
Okay.
it's I think that there's pocketed distress in either scenario. It's just the magnitude is going to be different. Either way.
Yeah. And then, just as an outside, there's no article to back this up, but there was an overall investor sentiment reading that came in lower, and I wonder how CRE investors are going to view this. I think there is a case, but it requires some education to kind of understand where the pressures are and what's going to happen to housing demand and what's going to happen to the for sale market with lower rates. I do think that when the Fed funds rate goes down, when the 10-year Treasury goes down, people get more excited.
They do, but I also think we're in just, I guess, I think the feeling today, like 10-year Treasury is down.
Yeah.
It's 4.16 when it was 4.5, 4.7 a couple of weeks ago or a month ago. So that's like really good. But it's still hard to make a decision. Like, I'm going to go buy out a property. Yeah. I'm going to put fixed rate debt on it that's going to be indexed to the 10-year Treasury. The 10-year Treasury can move around 60 basis points plus or minus.
Yeah.
And so it's like, that's great. We're at 416 today, and I'm hoping it gets into the threes, but we could be back at 470 tomorrow. And so it's hard to make the volatility has just assume a range.
Yeah.
And if you're being conservative, you assume the top of the range.
Yeah.
So until there's some stability of the 10 years been hanging out around 3.5 or 3 3.75, whatever the rate is, 4. Like, if it's consistent, then I think that'll allow the market to function a little bit better. Now, in the Fed funds rate, though, there's talk of more rate cuts now, potentially lower growth, maybe not as much inflation.
Well, and that's something that is interesting, because I haven't heard a whole lot of speculation that we'll be facing stagflation, because the consumer confidence numbers and the consumption numbers, they're not the underpinnings of a very active and hot market when it comes to like people spending money. That could change if people maybe feel like they're getting this hoarding mentality with increasing inflation, but it would require an external impact and probably sustained tariffs to take in.
I am. You mentioned investor sentiment. I am worried about. Although I think it's probably is going to be long-term healthy, I'm worried about the retail LP investor who invests in multifamily.
Yeah. And
I think there's going to be a lot of investors who are jaded and aren't going to invest in multifamily going forward.
Yeah.
When I started getting into multifamily investing 2015, 2016, it was a different world. And once I got to a point where I was starting to raise capital in like 2017, this my experience was you do a deal. I'll describe typical multifamily deal. You invest it, you do value add and deal, let's say, and the time we were using a bridge loan to do some of the construction work, but we were quickly taking it out to a HUD long-term fixed rate 223F loan. It had 35-year term fixed rate debt. And so you'd have interest only for the first, 9, 12 months while you're doing some rehab. Line of credit was funding that. We'd have, 10% cash on cash in the first year.
Yep.
You close in your fixed rate, fully amortizing debt. You could still throw off 8+% cash on cash. So you're delivering a current preferred return of 8% plus. That is sheltered from depreciation. So that means that you're not paying a full regular, income tax rate on that distribution because it's sheltered from depreciation. So, that's like if it was taxable, you'd be like double digits or more. That's really attractive.
Yeah.
And then you'd execute your business plan probably early, and you'd sell for a 2x plus within 3 to 5 years. And there wasn't a big perception of risk because there weren't really hardly it was hard to find a deal that was failing. Yeah. I mean, there were some really bad operators here and there. Maybe someone bought in a really bad part of town. But generally it was like everyone's seeing a lot of success. This is smooth sailing. But then enter 2020, enter the pandemic, which made things crazy good for a minute.
Yep.
And then it was too good to be true. Everyone's like, man, this was low risk before. Now these guys are making hands over fists. I need to get in on this. And okay, I need to syndicate some of these deals. Why not? I'll hire a third party manager, or take out a bridge loan, and on any type of deal, just because that's where I'm going to get the highest proceeds, short term floating rate debt, never fix it, just keep riding it.
Sure.
And so now when we're having conversation with investors, we raise money, we raise capital from, I call it, accredited retail limited partners, high net worth and ultra high net worth individuals that are investing $100,000 to $1 million. And then we also work with, RIAs, the wealth managers and family offices. When we're having conversations with existing and new prospective limited partners, investors, it's about every other conversation that if they were active in investing in multifamily, the majority of those calls say that they are going through a capital call right now.
Yeah.
To some extent. And some are going through many capital calls. And it made a realization because we get people saying, they're like, oh, I wish we would have invested with you guys.
Yeah.
Or we have investors who invested with us, but then they diversified. And something that I've always said was a good idea, I've always encouraged is, diversify across different sponsors, geographies, kind of asset classes or asset types, do some core, do some value add.
Yeah.
And in theory, that makes a ton of sense because diversification is good. But I think what happened was, in order to, let's say you want to you want to do that. And so you want to have a syndicator that's based in the Sun Belt, or somebody that's in Florida, somebody's in Texas, somebody that's on the Mountain West, somebody that's in the Midwest, and somebody on the East Coast or the Carolinas, something like that. To do a good job of vetting, to finding that one person, you probably need to find, 5 or so of sponsors to interview and to look into all those different geographies.
Yeah.
It becomes a large task to put all that together. And I think that the due diligence got shorthanded because it's like there's only so much time to do my research on all these different groups
and maybe you don't have a whole lot of
markets.
history. Some of the groups don't, haven't been around for a long time.
Well, that too. It's like, well, I met this one guy.
And everything was going great.
And he seemed like a really nice guy. And everything was going good at first.
Yeah.
And he had done another deal. And I talked to an investor, and he was a really nice guy. And, things were going fine until things weren't. Because things were going fine for everybody. No one had any issues to deal with.
Yep.
And it wasn't until we had problems, whether it was COVID or higher interest rates or negative rent growth, high supply, higher expenses, that investors got to see how their sponsors reacted to those problems.
Yeah.
And some of them had addressed them head on, found solutions, took strategic decisions. Others kind of put their hands up in the air and they were like, oh, I don't know what to do.
Yeah.
I thought this was easy. I thought my property manager was going to do it. And so there's this big just surprise and letdown to some. And I think people also were blaming themselves because at the end of the day, they made the decisions to make those investments. And so they're not mad at the sponsor, maybe, and sometimes they should be, sometimes they shouldn't. But I don't think there's going to be. I see a lot of LP investors, at least in the short term, who are just like, I'm done. Like I tried.
That's what I was gonna say too. Is like it kind of makes you feel, oh well, we did well while the other ones didn't do well. But the net result is people are getting bummed out on investing, and then when they call back on us, it hurts us because we don't get them as an investor.
Yeah, they're like, well, I'm gonna look at like a data center deal, because that's kind of more in vogue right now, or whatever it is, it's a different part of real estate, or if it's a different asset class, other than real estate altogether. The more institutional family office investors, the people who have been around prior to COVID, are still going strong because this is just like a data. There's a couple additional data points, but like when I look at my history of multifamily investing, going back a decade, it's like, well, the good far outweighs the bad, and the bad has more of just been like challenges that we've had to navigate. And the real difference has just been an expansion of like timelines in some cases, and or really just a acknowledgement of like, well, yeah, we always said this was going to be a 7-year hold, like it's going to be a 7-year hold. It's not necessarily this is going to be a 3-year hold, but now it has to be a 7-year hold. But just in previous years, it was the 7-year hold turned into a 4-year hold because we
That's what I was
blew them.
wondering
Yeah.
if during the really boom years of multifamily, some of these, it was a case where some groups came up into it, they started it, they had a lot of transactions, and they built up this transaction history that had huge numbers, and so investors are like, oh, I want to get that, but then that last person
Yeah.
experience, no. On the other side, it's the fall is just as rapid.
Yeah, it's going to be like average, IRRs from previous deals are, they're going to be, here's I got a 70 because it was in 2009. And then, and then it was like, 40 and 30 and 30 and 30 and 20 and 30 and 20 and 30, 20 and 30, like all these 20 to 30% IRR, 40% IRR, 30% IRR. And then all of a sudden, starting in 2023 or 2024, it's going to be like 12, 7, 6, -1.
And that's
12,
and that's
14,
accurate.
15. You average it all up. Yeah, it's probably 15 plus. It's still like, it averages itself out. But I think, and we discount our track record a lot of the time. I speak with investors. Our track record is like an average 30 some IRR, but we sold a lot during the peak time, which was the right time to sell. But we just don't have a lot of transaction history of when the market was down, because whether we chose not to sell during that period of time or we're just holding on longer. And so it's hard to tell investors because we're like, hey, look, we've got a deal and we're really excited about it. Right now it's looking like it's going to be a 16 IRR, but it could do better. In a variety of different circumstances, but like this is a good base case to think about. Then investors are like, well, but your average returns are like 30%. So like, is this deal not as good as those deals? And I have to go back and go, well, we underwrote that deal as a 16 IRR also.
Yeah, you don't go looking for those. That's not the way you go looking for it.
And also in the return, like the returns are different. It's like, well, why can't I'm really looking for a cash on cash deal. It's like, okay, so prices are down, 15% or so, but leverage is also way down. Interest rates are way up, and growth is moderate. Now, I could assume higher growth in latter years because of all the things we've talked about, lack of supply and all that. But then you're going to tell me I'm being too aggressive. But how do I achieve those returns? How do I achieve an 8% cash on cash when cap rates are still in the 5% range, some even maybe sub 5? Interest rates are also in the 5% range, but leverage isn't 75%, it's 60%. So just like the math is going the opposite direction, and you can still find good deals, but those returns are just going to look different, at least if you're looking at it through today's lens and the reality of today of, well, interest rates are going to stay high and leverage is going to stay low. But I think it's, and it could stay like that for a longer period of time and longer than people feel comfortable for it remaining. But there are cycles, and we will move out of this cycle at some point.
It does seem
it's
like
just a matter of time.
Like we've hit some kind of floor, and things are moving up in a lot of different ways. And we'll see in this apartment list report, but things are starting to go on the upswing.
Well, let's take a look at that apartment list report, Matt. Always love featuring the apartment list reports. Nice, kind of to the point. Man, we've just been oscillating here, but rents certainly lower than they were several years ago, but a little bit of pickup early in the year.
So we're not anywhere close to what would be normal rent growth, and may not approach that this year, but actually we may get closer than you would think, especially after being programmed for 2 years, maybe 1.5, or I don't know, for years that rent growth was very low. Rent growth in 2021, huge, high, great. Ever since then, though, rent growth has been lower and lower and lower, and you see it in this line graph, just that kind of steady progression since the start of basically mid 2002, and now until now. But so that being said, this monthly increase in February was bigger than last year's monthly February increase, which it was itself bigger than 2023's February month-over-month increase. So for 2 years, we've been working through this apartment supply boom, and I also think the aftershock of the huge rent growth in 2021 and 2022. So things are finally see. I mean, you can see in this chart, it looks just like you dropped a rock in a puddle and the waves are slowly coming back towards the mean. But as gradual as it is, this increase in rent growth, slowly over 2 years, is a strong indicator, I think, of further growth as we progress into spring and summer. So that's peak renting season, and there is signs, barring like we mentioned earlier, a complete collapse of the economy. I think that there are certain, this is bad for renters, but when inflation comes, rents also goes up, and so that could be an effect. Even outside of that, though, the incoming apartment supply shortage and a bunch of other factors are pointing to improved
Yeah, we're seeing
apartment
this.
demand.
We're seeing this growth admits all the same time. Well, I mean, supply is still coming online.
Yeah.
This peak in supply is still happening right today, and it's going to happen throughout the year, and even in early, the first part of 26, there's going to be a decent amount of supply.
Yeah.
It'll start to, in different markets, it'll start to taper. Some markets have it's already started to taper. End of 25, tapering.
It's funny the supply wave, because it's a little bit concentrated in coastal markets.
Yeah.
If you chart it, it is like a tsunami hits, and then it stays the longest on the coastal markets, and then it's fading away. So that's just a nice visual.
People like living on the coast, but I mean, just graphically, I mean, you look at, if I'm only looking at the declines, the negative rent growth periods in the slow season, which is after everyone starts school through winter, and then it starts picking up like today, in March. I mean, the declines starting before end of 2022 into 2023.
That's our current regime.
That was the largest, and then the next year at the end of 23 and 24 was a little bit less on the declines. Growth was about the same, maybe a little bit higher, but the declines for 2024 were similar, but still more subdued.
Yeah.
And again, that's in the period where we were seeing this peak supply. So I think we're moderating in the right direction.
It's just taken basically like 3 winters and 2 summers or worth of this like rent growth regime.
And that's where just some investors are tapping out. They're like, I'm done. There's investors who, syndicators and operators, who are like, planning on getting some rent growth.
Yeah.
I need to move rents. Was this period where rents have been, coming down, expenses have not been coming down. Expenses are way up. Payroll is way up. Contractor services are way up. Property taxes are way up. Utility, just the whole list. I can read all the GLs. I didn't even mention insurance.
Jinx.
So so you can see how some operators are like, I've had enough of this. When is it going to turn around? And again, you have to be reminded, cycles are everywhere.
Yeah.
And we're in the middle of one. We're in the middle of the trough of a period, and this is exactly why that we published. We just released a new report.
Yeah.
We talked about it last week, but in the multifamily window, why 2025 could be one of the best buying opportunities in years.
Yeah.
You can find it greatcapitalllc.com/window. We put this quick research brief together basically to highlight the fundamentals that are driving a positive thesis for over the next 5 to 10 years.
Yeah, and these fundamentals aren't just things that are popping up like tariffs that could be turned on and off. These are multiple year, multiple month trends, whether it's momentum in the sales activity that's been building for the past 3 quarters, or it's momentum for absorption, which has been doing the same thing. Last year was the highest amount of absorption outside of huge 2021, but so number 2 in absorption in over 25 years.
Yeah.
So we're at generations high when it comes to apartment demand. It's just once you see that supply shrinking down, all signs are that demand is going to continue because of household growth is continuing as well.
And then the affordability component also, or the lack of affordability in single family homes is going to continue to drive folks into renting. Yeah. Amidst a scenario where we don't have any more apartments being built. And so the translation of that is typically higher rents and higher asset prices.
People have a long memory when it comes to rent increases, and I don't blame them. The rent is too damn high party. It's like it's never left my imagination.
All I can think of when I'm looking at this chart is that the bottom half of this graph where rents were averaging, just around $1,000. This is the world that most renters remember that they think rents should be. Even in this period in the late 2020s, they thought things were, or in the early 2020s, they thought rents were still really high. But their impression is like, look, my rent was $1,000. Because they're being extreme, and now it might as well be $1,500. My rent's gone up by $500. Neither of those things are necessarily true, but that's how they feel. And now multifamily investors are like, all we think about is this high price back in mid 2022, and so we're like, oh, rents are down. And because my expenses are up, and if we can't increase rents, we're not going to be able to maintain this property, let alone issue distributions and execute our fulfill our the business plan. So I think those who are patient, who have patience, are going to be the beneficiaries of the market, and those who have the stomach to make some buying decisions this year, next year, when there's a feeling of like maybe there's no end in sight. But again, we said this before. Sometimes it's the darkest before the dawn.
And I think that there could be interesting opportunities that come about because of this uncertainty. I really hope that this is not going to be one of those cases where people sit and wait it out. Like we mentioned before, there were 3 quarters consecutively of building multifamily sales activity. However, that's still a fraction of what it was previously. So we're still under, we're very low when it comes to multifamily sales volume, but it's building. There's a little silver lining. We still have got a long way to go, though.
Yeah.
So another part of this is they actually are recording higher vacancy. Apartment List is one of the few sources, and maybe the only one amongst like RealPage and Yardi Matrix and CoStar to record a decrease in vacancy. In a lot of the other sources that I've seen, to record an increase in vacancy. A lot of the other sources say that occupancy is improving, vacancy is declining, but Apartment List has a slight tick up, 6.9. It was at 6.8 for it seems like forever, and now it's back and now it's up to 6.9. I think that as the apartment supply situation it kind of comes more into balance with demand, that will come down, the vacancy will come down. But that's something to note here, is that we're still in this elevated supply environment, and that's not going away anytime soon.
Yeah, it's not surprising that we would see vacancy rates increase in a peak supply environment. And again, we've mentioned that it's actually more surprising that we don't see higher vacancy. Given that we're seeing so much supply, which is because of the higher than anticipated demand that we're seeing.
I do want to note the at the very bottom of this or close to the bottom, is a regional map that shows how different markets go. So you kind of hover around and see, but it's color coded with the red that is seen in the Northeast and in Midwest. Those red colored markets have higher rent growth than the blue colored markets, which are predominantly in the Southeast, a little bit in the West, and those are the ones also that have a lot of apartments that were just recently built, working through those supply. Some really low rent growth, like in Austin, Texas, as we know, negative 6.8. In Denver, Colorado, negative 4.6. Raleigh, negative 3.2% rent growth. Not great in the Sun Belt. Really doing well in
Manhattan, Kansas.
Is that near Kansas City?
Yeah, sort of. Not really.
Near Topeka. Well, okay, 12% rent growth of the large minimum. So of the markets with at least 1 million residents, Cleveland, Ohio has the highest rent growth.
Ooh, San Angelo, what's going on?
Yeah,
what's going on down there? I don't know.
Sure,
what's going on? You guys all right? What's happening?
But yeah,
Austin, Texas, again, negative 6. Texas is still. San Antonio, negative 2.6.
Yeah.
Dallas, negative 2.8. Man. And this is, again, so back to my point of just multifamily investors, negative sentiment. So many multifamily investors across, not just retail, institutional also, Sunbelt.
Yeah.
Florida and Texas, throw in the Carolinas. Maybe a little bit of Atlanta, and then sprinkle in some of other markets. But Florida and Texas. And so a lot of retail and LP investors invested in Texas. Because there's so much growth in Texas, which is absolutely true. There's some incredible fundamentals. A lot of people are moving there. Jobs are moving there. But that means a lot of apartments were built there, and more apartments than they needed in that short period of time. So many I mean, Dallas down 2.8. Even,
And you
Sherman,
can
Texas
see
down
this,
4.2.
and I was at
Houston down.
you can see this kind of on the market level as well. If on the sub-market level, that is. I was just at a meeting, the seminar from the local NIOP, and they talked about how some of these submarkets in Indianapolis that were really popular, people built a lot, and now they're also working through supply. So, it's a story that is a little bit of what do you call them? Microcosm or something
Oh yeah,
like that.
yeah, no, 100%. Even in the Midwest, where it's like we have much more balanced supply, it's the same type of story that's taking place in Austin, just at a very different level.
Yeah, yeah.
Where there are certain markets in Austin where they're still growing because they're like, yeah, we didn't build as many apartments around this area. There's parts in the suburbs of Indianapolis
Yeah.
where like literally some parts in Westfield where it's like everyone decided to develop apartments in this same quarter-mile area.
Yeah.
Like all the apartments went in right here and they're all in lease up at the exact same time.
Yeah.
And when you look at the job growth and population growth, you can determine that these will absolutely lease up. There's clearly the demand and people moving in, but how quickly they'll lease up?
Yeah.
And what will it take if everyone is in a concessions war and everyone's giving away $2,000 a
Yeah.
month here and a free TV there, and then you have to keep that up, and then there's more supply coming online. It's just how much patience and cash does the developer have to get through that period?
Yeah.
Because they've got this interest rates have gone up, and then what the hardest part is that a lot of these assets, the newly developed assets, aren't worth as much. They're worth about what the debt is on the property. So the equity's gone.
Yeah.
Because they were developing to these unrealistic development yields, and then they're on their pro forma, but then costs went up, from materials costs to their interest carry, and then the sale environment is deteriorated of where they're not able to sell these assets at a 4 cap like they were hoping to.
I mean, it's funny. Last week we were talking about how Fannie Mae has upped their projection of multifamily construction because some builders are continuing to build even though the conditions aren't great. I wonder if they revise it down just because of all the new pressure and the new chaos that the tariffs might make. Now, you never know. Yeah. Maybe it'll cause rates to come down, but there's a whole lot of things that I can't predict that I would have been able to more confidently predict last week. Yeah.
Oh, it keeps shifting, and where last year, Matt, it was inflation expectations were shifting every 3 weeks. Now it's going to be on to the next economic story, whether it's tariffs or whether it's, again, geopolitics, whether it's going to be taxes. It's going to be, we say this maybe too much, but there's going to be a lot of noise out there.
Yeah.
It's going to be a noisy environment, and it's going to be hard to make decisions. And there's going to be mistakes that are going to be made from investors, politicians, policymakers. There will be some people who find some incredible opportunities, multifamily or otherwise, and are going to be able to make a lot of money.
Yeah, and I suspect it's people that can handle the challenge of operating during when times are tough, rather than people that are just find the right time and find the right moment. Like, you've got to be able to actually execute and actually run it.
Yeah, and there's, I don't know, I find myself thriving sometimes in chaotic situations of I don't know. Sometimes I just don't get as stressed out about things as other people.
Yeah.
And I see people. I noticed it starting in high school. People would be like, I haven't figured out what college I'm going to.
Yeah.
And I'm like, you're a sophomore.
Yeah,
Why are you worrying so much?
Yeah.
And sometimes I thought of it's like, well, maybe I don't care as much, but like I do care. I don't get so emotionally wrapped up into this like worst case scenario. Like, what if I don't get into this school? What happens then? And then what happens the rest of my life? I've always had, I guess, confidence in my ability that I'm going to be able to figure it out.
Yeah.
And in situations where, whether they're like dangerous, life-threatening situations, or just the stakes are high. We've got to make decisions. Notice some people close down and go, "What do we do?"
Yep.
And they look around and they look for somebody like, "What do we do?" And then there are others that say, "This is clearly what we have to do, and we need to do it now." And when times are like normal, I find myself, it can be harder for me to make decisions because maybe the necessity isn't there.
Yeah.
But in times where decisions absolutely have to be made and it's critical, it's like, let's get this fucking done.
Yeah.
Let's figure it out. Especially when sometimes it's just the lack of decision elsewhere. It's like no one else can make a decision. Someone has to step up and make a call.
Yep.
In almost every time, it's better to make a decision of pointing a direction to go rather than no direction and no decision.
Yep.
And no plan. Any plan, a bad plan is better than no plan. So
there's going to be a lot of opportunities this year, and this week did not reduce that at all. Didn't reduce the risk, but didn't reduce the opportunity. So
are you going to be? Are you watching the president's statement to
for sure.
Congress?
He's going to explain everything, and we're all going to be fine. Next week we'll be saying, "Oh, why were we even worrying?"
Yeah. You think he's going to say anything like make multifamily great again, or make the 10-year?
Well, that depends on if NAHB wrote a letter to him in time, then maybe he'll say it.
I don't think so. I don't think so. Yeah. Well, let's watch the 10-year. Let's keep our ears to the ground.
Yep.
And again, I reiterate, I think there will be opportunities for failure to trip, but I think there's going to be great opportunities for some great investment opportunities, and just to people often look back and they say, I wish I would have done this then. Wish I would have made that move. Wish I would have made that bet. I wish I would have bought Bitcoin when it was $50. I wish I would have not sold all that Bitcoin when it was a couple $100.
Yeah.
Someone gave me 10,000 Bitcoins and I sold. Okay, well, this is your opportunity now. In the next couple months or a year, or maybe right this second, to make a decision that's going to put yourself in a really good position for the future. It's not always obvious, and in fact, there will be a counter narrative to whatever you're going to do, and even some logic to say this is a bad decision. Sometimes it's going to have to be a judgment call backed up with data. And again, related to multifamily, hop on over to greatcapitalllc.com/window. We've got this new research brief that just lays out, because I was like, Matt, we got to lay out for people, not just that, like, our gut tells us, because the supply is coming down, that multifamily is going to be great to invest in over the next 5 years, 10 years. Let's lay out all the data to make it really clear, because it's turbulent, it's volatile, and no one can make sense of what's up and what's down. And so let's just stick to our principles, stick to the fundamentals, use good judgment, and not get distracted by the latest headline.
Yep. I agree.
All right. Well, thanks for watching this episode of The Great Report. Check out the new research report, greatcapitalllc.com/window. We're talking about the multifamily window, why 2025 could be your best buy opportunity. And while you're at it, subscribe to the Great Capital newsletter, find at greatcapitalllc.com. And we do have an investment opportunity that's open for accredited investors. You can go to the website, Great Capital. Just search Great Capital Investments, Great Capital Multifamily. We're going to pop right up. And if you're not subscribed to the Great Capital YouTube channel, make sure you do it, and we'll catch you. And if you gave a comment about T-shirts, do we have our T-shirts and cheese boards out to the folks that...
Yeah, we did. They have them. I got an email back, confirmation.
They already sent them? They already got them? Good. Well, leave another comment if you haven't gotten your T-shirt or cheese board. We'll keep the team busy heading over to FedEx. All right. Thanks, everybody.